Developing real estate is like constructing a skyscraper. It requires meticulous planning, unwavering dedication, and a clear vision of the final outcome. It takes vision, planning, and a solid foundation to succeed. Every detail, from the initial blueprint to the final brick, must be carefully considered and executed. One of the most critical elements in this process is securing the right financing. Without the proper financial backing, even the most well-thought-out plans can falter. Whether you're building a single-family home, a sprawling apartment complex, or a bustling commercial center, understanding your financing options is crucial. Each type of project has its own set of financial requirements and challenges. This essay will be your guide to navigating the exciting and sometimes complex world of real estate development financing. We'll break down the various options available to you and help you understand the pros and cons of each. We'll explore various financing methods, from traditional bank loans to innovative equity partnerships. Each method has its own set of benefits and potential drawbacks. We'll delve into government programs and explore the world of private lenders. These sources can provide the necessary funds to bring your vision to life. Remember, each project is unique, and there's no one-size-fits-all solution. The financing strategy that works for one project may not be suitable for another. The key is to arm yourself with knowledge, carefully analyze your options, and choose the financing strategy that best aligns with your goals. This approach will help ensure the success of your project. So let's lay the groundwork and build your real estate dreams, brick by brick. With the right planning and financing, your vision can become a reality. Real estate development requires significant capital investment. The sheer scale of these projects means that the financial demands are substantial and often overwhelming for individual investors. From acquiring land to construction costs, every step of the process involves considerable expenditure. Permits, marketing, and unforeseen expenses can quickly add up, making it essential to have a robust financial plan in place. Unless you have unlimited personal wealth, you'll need external financing to bring your vision to life. This is where banks, investors, and other financial institutions come into play. Understanding the myriad of financing options available becomes paramount. From traditional bank loans to private equity, each option has its own set of advantages and challenges. Securing the right type of financing at the right terms can mean the difference between a profitable venture and a costly mistake. The terms of your financing can significantly impact your project's bottom line. A well-structured financing plan provides the financial fuel for your project, allowing you to focus on what you do best: developing exceptional properties. It ensures that you have the necessary resources at each stage of development. Moreover, the right financing partner can provide more than just capital. They can be a strategic ally in your development journey. They can offer valuable expertise, industry connections, and guidance throughout the development process. This collaborative approach can help mitigate risks and enhance the overall success of your project. This support can be invaluable, especially for first-time developers or those venturing into new markets. Having a knowledgeable partner can make navigating the complexities of real estate development much smoother and more efficient. Before you approach any lender, you need a comprehensive financial plan. This document outlines your project's feasibility and demonstrates to potential funders that your vision is financially sound. Your financial plan should include a detailed budget, projected timelines, and a thorough market analysis. Clearly articulate your project's revenue model and demonstrate how you'll generate returns for both yourself and your investors. Be realistic in your projections and factor in contingencies for unexpected expenses. A robust financial plan is your roadmap to success. It helps you track progress, make informed decisions, and secure the confidence of lenders and investors. Remember, a well-crafted plan is not just about securing funding, it's about setting your project up for long-term success. Traditional bank loans are often the first stop for real estate developers. Banks offer various loan products tailored specifically for construction and development projects. These loans typically come with competitive interest rates and flexible terms, making them an attractive option for experienced developers. Banks conduct thorough due diligence before approving loans. Be prepared to provide a detailed financial plan, market analysis, and information about your experience and track record. Banks are looking for projects with strong financials, experienced developers, and a clear exit strategy. Section 5. Navigating bank loans, types and requirements. In this section, we will explore the various types of bank loans available for real estate development and the specific requirements you need to meet to secure them. Banks offer several types of loans to cater to different stages of the development process. Each type of loan is designed to meet the unique needs of a particular phase in the project. Construction loans, as the name suggests, finance the building phase. These loans are crucial for getting the project off the ground and ensuring that construction can proceed without financial interruptions. These loans are dispersed in stages, known as draws, as construction progresses and certain milestones are met. This stage disbursement helps manage risk and ensures that funds are available as needed. Once construction is complete, developers often refinance into a permanent loan. This transition is essential for stabilizing the project's finances and securing long-term funding. This type of loan typically has a longer term and lower interest rate than a construction loan. The lower interest rate helps reduce the overall cost of the project over time. Banks may also offer acquisition loans to finance the purchase of land for development. These loans are vital for securing the property on which the project will be built. To secure a bank loan, you'll need to meet specific requirements. These requirements are in place to ensure that the borrower is capable of repaying the loan and that the project is viable. Banks typically require a down payment, often 20% or more of the project cost. This down payment demonstrates the borrower's commitment and reduces the bank's risk. You'll also need a strong credit history, proven experience in real estate development, and a detailed financial plan that demonstrates the project's viability. These qualifications help assure the bank that the project will be successful and that the loan will be repaid on time. Section 6. Equity financing. Sharing the risk and reward. Equity financing involves partnering with investors who provide capital in exchange for ownership stake in your project. These investors share both the risks and rewards of the development. If the project is successful, they participate in the profits. However, if the project faces challenges, they also share in the losses. Equity financing can be an excellent option for developers who may not qualify for traditional bank loans, such as those with limited experience or a shorter credit history. It can also be beneficial for larger, more complex projects where securing sufficient bank financing may be challenging. Section 7. Tapping into equity sources and considerations. There are various sources of equity financing, each with its own set of advantages and disadvantages. Private equity firms, family offices, and high-net-worth individuals are all potential sources of equity capital. Crowdfunding platforms have also emerged as a viable option for raising equity from a larger pool of smaller investors. When considering equity financing, carefully evaluate the terms offered by potential investors. Pay close attention to the percentage of ownership they seek, their level of involvement in the project, and their exit strategy. Aligning with investors who share your vision and values is crucial for a successful partnership. Section 8. Government incentives fueling development with grants and programs. Governments often offer incentives to encourage real estate development, particularly for projects that align with specific economic or social objectives. These incentives can take various forms, including grants, tax credits, and low-interest loans. For example, many municipalities offer tax increment financing, or TIF, where a portion of the property taxes generated by the development are used to offset infrastructure costs. Other programs may provide grants for affordable housing projects, historic renovations, or sustainable building practices. Section 9. Private lenders. Bridging the gap in financing. Private lenders, such as individuals, investment groups, or specialized lending companies, offer an alternative to traditional banks. These lenders are often more willing to finance projects that fall outside the strict criteria of banks, such as those with higher risk profiles or unconventional structures. Private lending can be a viable option for experienced developers seeking quick access to capital or those pursuing projects that may not fit traditional lending models. However, it's essential to understand the terms and conditions associated with private loans, as they often come with higher interest rates and shorter repayment periods than bank loans. Section 10. Hard money loans, quick capital, higher stakes. Hard money loans are a specific type of private loan typically used for short-term financing, often for a period of 1 to 3 years. These loans are primarily based on the value of the underlying property rather than the borrower's credit worthiness. Hard money loans can provide a lifeline for developers facing time constraints, such as those needing to secure a property quickly or bridge a financing gap. However, they come with significantly higher interest rates than traditional financing options and often require a substantial down payment. Section 11. Conclusion. Your real estate venture awaits. Financing is the lifeblood of real estate development. By understanding the various financing avenues available, from traditional bank loans to equity partnerships and government incentives, you can choose the best path for your project. Remember, securing financing is not just about getting a check. It's about finding the right partners who share your vision and can support your journey. With careful planning, a compelling financial plan, and the right financing in place, you can turn your real estate dreams into a tangible reality. So, step confidently into the world of real estate development and watch your vision take shape, brick by brick.